recording? Okay, now this case study is about economic prospects reverse in Latin America, right? Over the past decade, Brazil boomed and grew rich by selling raw materials to China. Brazil's economy averaged 3.6% annual growth, peaking at a rate of 7.5% in 2010. Its currency, the Brazilian real, substantially increased in value, right? So what's this talking about? That over the decade, Brazil grew, economically, it boomed and it grew at a fast rate by selling raw material to China. Brazil's economy averaged 3.6% annual growth. So from year to year basis, the GDP of Brazil grew by 3.6%, and this was highest. The growth rate was highest in 2010 at a rate of 7.5%. Its currency, the Brazilian real, right? So the name of the currency is Brazilian real, substantially increased in value, right? By comparison, Mexico saw lower growth, partly because it was tied to a flattering United States economy. Mexico also suffered from deep problems of its own, for example, poor education system and a rise in violent crimes, deterring tourists and investors. Mexico economy averaged 2.6% annual growth over the past decade, while its currency, the Mexican peso, fell slightly in value, right? So Mexico is doing bad, right? Why so? Because the crime rate was high, education was not that much, and the average growth rate was lower, 2.6% annual, right? And the peso, the Mexican peso, the currency was also falling. Its exchange rate was falling, right? So from 2012, it was Brazil's turn to struggle as China's demand for its raw material decreased. Now, what happened in 2011? That China's demand for Brazilian raw material started to decrease, right? In 2013 alone, Brazilian currency depreciated by more than 10%. So there was 10% depreciation in Brazilian currency due to lack of demand for Brazilian raw material by China, right? Now, the Brazilian government largely wasted the boom years investing little in roads and other infrastructure that could have supported its development. In addition, many households borrowed money to finance a consumer boom, including a rapid rise in imports of luxuries from USA. As a result, a significant trade deficit in goods and services developed. Now, the problem was that Brazil did not invest a lot in infrastructure, roads, and as it says, roads and infrastructure that could have supported its development. Moreover, the Brazilian households started borrowing, right? So they were borrowing more than what they earned so that they could buy more goods and services, right? And what they did with that borrowed money, that they were buying luxuries from USA, right? So obviously, when you import expensive items like cars and so on and so forth from USA, then what does it do? It makes your current account go in deficit. So that is exactly what happened, right? Meanwhile, the Mexican government used the past decade to significantly strengthen its economy, improving the education system and making its telecommunications, financial and energy sectors more efficient. So Mexican economy, on the other hand, became more strong. Why? Because it improved its education system, it improved its telecommunication, financial and energy sectors to become more efficient. Economists now expect the country like Mexico to grow more rapidly when Mexico's biggest trading partner, the USA, recovers economically, right? Now, USA is Mexico's biggest trading partner and USA is recovering, which means that the boom is coming back in the US economy after depression or recession. So that is expected to boost economic growth in Mexico further, right? Yes or no? Okay, then what it says, also Mexico's exports manufactured goods to growing European markets, right? Also, Mexico is exporting manufactured goods to European market. At the same time, Mexico has maintained a relatively small trade deficit that can be financed easily by long-term foreign investment in its companies and factories, right? So Mexico has a small trade deficit, unlike Brazil, right? And the case study says that it could be easily financed by long-term investment by foreign companies in Mexico, in Mexican companies, right? So it was an article published on Wall Street Journal, September 2013, right? So that's the source. Okay. Now, after reading the case study, let's look at this information that we're provided here. Gross domestic product in US dollars, trillion of dollars, right? A tale of two countries. So what is the gross domestic product, Mexico and Brazil? So you can see that in 2013, Mexico's was slightly higher than Brazil, but after 2005, yeah, almost at 2005, the two economies had almost the same GDP, which was almost $1 trillion. Not exactly 1 trillion, but around 1 trillion. But after 2005, you can see that the Brazilian GDP increased significantly, whereas the Mexican GDP did not increase that much. So that was the first table, figure 1. Then the second graph below this, as you can see, is percentage change in how many US dollars each currency buys, right? So percentage change in how many US dollars each currency buys, right? So think about this. So Brazilian real is the light gray graph, and the Mexican peso is the dark black graph, right? Now, at the start of 2004 or 2003, as you can see, the two currencies were at 0%, like they were starting at the same point. But then over time, Brazilian real increased more in value against dollars. Against what? Dollars. Why? Because percentage change in how many dollars each currency buys. So if the graph is going up, what it means that this currency can buy more US dollars. And if a currency can buy more US dollars, we do know that the currency is becoming stronger, right? Yes or no? So it's just like saying that if Pakistani currency, rupee, can buy more dollars. 1 rupee previously used to buy, let's say, $0.50. Now 1 rupee buys $1. So it's dollar that's becoming stronger, and it's rupee that's becoming stronger, and it's dollar that's becoming weaker. So the higher the graph goes, the more stronger your currency is becoming. So in this case, you can clearly see that Brazilian real is becoming more strong, whereas peso is in fact depreciating against dollars, right? Easy. Okay. Now the question here says, use the production possibility curve to compare Brazil's economy in 2013 with its economy in 2003, right? Now what it says here, the first question for 2 marks is asking you simply, this is May, June 15. So let me write the name of the case study, right? So this is May, June 2015/22. So we'll just bold this thing, right? Okay. Now the first question is it ask you to use a production possibility curve to, to tell that what effect use the production possibility curve to compare the Brazilian's economy in 2013 with its economy in 2003. Now think about this. What happened over time? So over time, Brazil GDP increased, yes or no? Compared to 2003, in 2013, the Brazilian GDP is much higher compared to what it was before. Now you have to look at this very carefully. So when economic growth takes place, what happens to your GDP? Your economic growth takes place, your country's GDP increases. And how do we show it on the graph, right? So we show it on a graph through a shift in the point, through a shift from a point within the curve to a point on the curve. So how would you show that? Just give me a second. So you show that by just a second, right? So you'll show that through this way, right? So you will have, let's say, whatever it is, right? Wheat and let's say you will have wheat and, right? So let's say you have any two products on the X and the Y axis, right? So let's say you have, missing big time, right? So you have wheat and cars, so you can take any two products on the production possibility curve, as you would know, right? So how many quantities of wheat and car you're producing, right? So let's say this was your production possibility curve, right? Okay, now initially in 2003, let's say the Brazilian economy was operating at this point. So Zohan, just give me a minute, and Sandhya, just give me a minute. I'll tell you what we're doing in today's class, but for now, just follow what we're doing over here, right? No problem, right? Okay, so Khizr, you were saying that there would be an outward shift. There could also be an outward shift, but I am thinking more of, a movement from a point inside the curve to a point out the curve, right? Or towards the curve, right? So let me tell you, why am I not thinking about an outward shift in the graph? So I'm not thinking about an outward shift in the graph. Reason being that, the curve shifts outward when you get to discover more resources, or when the technology or the efficiency of these resources increase, right? Now, in the case study, there was no evidence provided that the currencies, the economy is like getting more resources, right? So that's why I'm not thinking that it will be an outward shift. But on the other hand, when economic growth takes place, what happens? You move from a point inside the curve. So let's say previously you were making, just giving you an example, right? So if let's say previously you were making 10,000 cars at point A, and let's say 5,000 tons of wheat, then compared to point A, you can see for yourself that at point B, how much more you're producing. So with movement from point A to point B, an economy would be able to produce more cars, right? So you can see for yourself, so it will be able to produce more cars, let's say 12,000 cars and 6,000 tons of wheat. This is making sense. So this clearly shows that now the growth, economic growth has taken place and the country can produce more output. Yes or no? Is it making sense? Right? Okay. Now, students, those who have joined us late, we'll very quickly read the case study, right, Zuhan? But I'll really appreciate, since we are doing case study nowadays and it's not possible to, understand once you are, once the class has started. So try to join it as soon as possible. Okay. Now, economic prospects reverse in Latin America. Over the past decade, Brazil boomed and grew rich by selling raw materials to China. Brazil's economy averaged 3.6% annual growth, peaking at a rate of 7.5% in 2010. Its currency, the Brazilian real, substantially increased in value, right? By comparison, Mexico saw lower growth, partly because it was tied to a flattering United States economy. Mexico also suffered from deep problems of its own, for example, a poor education system and a rise in violent crime, deterring tourists and investors. Mexico's economy averaged 2.6% annual growth over the past decade, while its currency, the Mexican peso, fell slightly in value. From 2011, it was Brazil's turn to struggle as China's demand for its raw materials decreased. In 2013 alone, Brazil currency depreciated by more than 10%. The Brazilian government largely wasted the boom years investing little in roads and other infrastructure that could have supported its development. In addition, many households borrowed money to finance a consumer boom, including a rapid rise in imports of luxuries from USA. As a result, a significant trade deficit in goods and services developed. Meanwhile, the Mexican government used the past decade to significantly strengthen its economy, improving the education system and making its telecommunications, financial, and energy sectors more efficient. Economists now expect that the country to grow more rapidly when Mexico's biggest trading partner, the USA, recovers economically. Also, Mexico's exports manufactured goods to growing European market. At the same time, Mexico has maintained a relatively small trade deficit that could be financed easily by long-term foreign investment in its companies and factories. Right? So this is the entire case study. Then we have two graphs over here. Let's see what they are showing us. A tale of two countries. Gross domestic product in US $1 trillion, right? So if you see, Mexico and Brazil were almost at the same point in 2004, right? So they both had something slightly less than $1 trillion of GDP. But after 2004, if you look at the graph, if you look at the trajectory for Brazil, so Brazilian GDP increased at a massive rate, right? So it was at the end, like in 2013, it was almost 2.5 trillion US dollars. So the total GDP of the country, or the total value of goods and services that Brazil produced in 2013, was around $2.5 trillion. Whereas for the Mexico, it was even below 1.5. So it was somewhere, I would say 1.2 or 1.3 trillion dollars, right? Yes or no? So that was the first graph. Then moving on to the second graph, what is this saying? So it's always important when you are reading a graph, you look at the axes, you read the axes so that you understand what this is exactly showing you, right? Now on the y-axis, as you can clearly see, it says percentage change in how many US dollars each currency buys, right? So percentage change. So it's a percentage change how many dollars each currency buys. So if the graph goes up, if the graph is going up for any currency, right, with this value mentioned on the y-axis, my question to you is that whether that would represent an appreciation or a depreciation. One. So if the graph is going up, where it says percentage change in how many US dollars each currency buys. So if the graph is upward sloping, would that reflect an appreciation or a depreciation? Yeah. So if your currency gets to buy more units of foreign currency, is that an appreciation or a depreciation from your currency's point of view? not talking about any other currency. Yeah. Any idea? No? Okay. Now, students, think about this. Think about this in an intuitive manner, right? So when your currency is buying more units of foreign currency, that's an appreciation. Why? Because now 1 unit of your currency is buying more units of foreign currency. 1 unit of your currency is buying more units of foreign currency. So that should be appreciation. Is this making sense? Right? So if you look at the two currencies, in 2004, they were starting at the same point. Then after 2004 till 2013, Brazilian graph went quite up, right? So Brazilian graph went quite up, right? Whereas the Mexican peso was on the depreciation, right? So Mexican currency overall during this period depreciated against dollars, whereas Brazilian real appreciated against dollars. So that's what you need to remember. Okay. Now, the first question here said, use production possibility curves to compare Brazil's economy in 2013 with its economy in 2003. So this was the first question we were answering. And what Khizr was saying that it might result in an outward shift. So outward shift also makes sense, right? Outward shift also makes sense, right? PPC, right? But outward shift in PPC happens when there is increase in the quantity or quality of resources, right? So when you have more quantity or quality of resources, then that's what causes an outward shift in your PPC, right? Why I am not assuming that it will be an outward shift, because there is no evidence in the passage that clearly states that over time Brazil get to discover more resources or the efficiency or the productivity of its resources increased. So therefore, what I think would have happened is that from a point within the PPC, the economy moved from a point within the PPC to a point on the PPC, on the curve, right? Why so? Because whenever there is economic growth taking place, that means that now a country is producing more goods and services. And therefore, as you can clearly see, that when you produce more goods and services, obviously the value of these services would also be, goods and services would also be higher. So it means an outward shift in your movement from a point within the curve to a point on the curve, right? So this is economic growth. So movement from a point within the curve to a point on the curve is economic growth. Is this making sense? Any confusion so far? If you want to look at the marking scheme, we can quickly look at the marking scheme to see if we did it correctly. Okay, the Brazilian economy has grown between 2003 and 2013. Candidates should provide a diagram of production possibility curve shifting outwards. Okay, okay. For an indication of an outward shift in the PPC as the Brazilian economy has grown, with appropriate axes correctly labeled. Okay, interesting, interesting. It's discovering more resources, perhaps the raw material. The raw material that it's extracting. I was thinking with the raw material that Brazil. Okay, so you were correct. You were correct, Khizr. Sorry, my bad. That when this country is, extracting more resources, so that would mean an outward shift in the graph. Makes sense, right? I was thinking on slightly different lines, but I'm glad that we looked at the marking scheme, right? Okay, so students, is this clear? Is everyone clear on this? Okay, now let's move to the next question then. Okay, now the next question here says, why is this too much on the right? Okay, now the next question, students, is this one. Use figure 1, explain what has happened to the value of the Brazilian real in 2013 compared with 2004. So compared to 2004, what has happened to the value of Brazilian real? So what would you say? What would you say, students? So the percentage change in how many US dollars each currency buys, what does it mean? So if the graph is going upwards, that means that your currency, Brazilian real, is buying more US dollars. Listen to me carefully, students. So if the graph is going up, that means that your currency, which is Brazilian real in this case, is buying a bigger percentage of US dollars. So that means your currency is becoming stronger. Yes or no? Right? Yes or no? So the way you will answer this is that, right? So the way you will answer this is since the y-axis lists percentage increase in the US dollars, in the number of US dollars, right? Percentage increase in the number of, in how many US dollars? Yeah, so it's the same thing. In the number of US dollars that a currency buys, and therefore, if the graph is going up, it shows that more units of dollars or more dollars can be bought with a certain with 1 unit of Brazilian real. And therefore, it means that over the period, Brazilian appreciated against dollars. Do you all agree with me? Students, are you all agreeing with me? Right? So that is what you were supposed to write in this, right? Brazilian real appreciated, right? So let's look at the marking scheme. It has appreciated, risen, increased, higher by approximately, right? Okay. Right, by approximately, okay, so we were also expected to tell by how much it has increased, by approximately 25%, right? So at the start of 2014, it was 0, and then it is around 25%. Yeah. So the ending point is 25%. So during these 9-year period, almost, so during this 9-year period, there is an almost appreciation of 25% in the Brazilian real against US dollars. Do you agree with me? Right. So what you need to be careful with, students, that you know, if there are 2 marks for a question like this, so 1 mark was for the correct identification that it has appreciated, and the second mark would be for how much increase it has taken place, how much appreciation has taken place. So you can clearly see that around 2004 it was at 0%, and then around 2013 it's closing at 25% at this benchmark, right? So there was 25% appreciation in Brazilian real against dollars. Confusion? Any confusion, students? Anything that's not clear? Right? Now the next question says, explain one possible. So what is this saying? So explain one possible reason for the stability of Mexican peso from 2004 to 2018, shown in figure 1. Stability. So what's the reason for stability of Mexican peso from 2004 to 2018? Where's 2004, 2004 and 2008, right? So there is also a hint given in the question. One possible reason for the stability of Mexican peso. So can you see that between 2004 and 2008, there is absolutely no change in the Mexican peso. So the graph neither went up nor it went down. So the graph neither went up nor it went down. So what could be a reason for that? Yeah, anyone? So there's also a hint in the case study. So here's the question, Joan. Explain one possible reason for the stability of Mexican peso from 2004 to 2008, shown in figure 1. So if you see for these dates mentioned, 2004 and 2008. So if you look at the dark black line, which is representing Mexican peso, right? So there is absolutely no movement, right? Hardly there is any movement up or down against US dollars. So what could be a reason for that? Right? Right. There's also a hint in the question, in the case study. Right. Let me show you where that was mentioned. Economy. Just a second. Flattered tide. Have a look at this. By comparison, Mexico saw lower growth, partly because it was tied to a flattering United States economy. Though there is not a clear hint of that, but let me tell you what could be a reason. So when one currency against another currency is not moving at all, what would you expect? Students, that should be simple. If one currency against another currency, which means basically the exchange rate is not changing at all. So if today Pakistan exchange rate doesn't change against dollars for 5 years or 4 years, that's big time period, How is that even possible? Because we know in foreign exchange market, the exchange rates are constantly going up, constantly going down, right? But if between two currencies, the exchange rate is very stable and for a period as long as 4 or 5 years, what could be the reason? You should know the reason. What are the different type of exchange rates? Come on, students, hurry up. What are the different type of exchange rates, right? So what would you expect? You would expect a fixed exchange rate. Excellent, right? You would expect a fixed exchange rate. Why? Because then the government makes every possibility, the government takes every possible step to make sure that its currency neither goes up nor goes down against another currency. So you're fixing your time, or you are pegging, as we say, fixing your exchange rate with another currency. Yes or no? Yes or no? Right? So the reason for this, right? So this is how you'll write it. The reason for lack of Mexican peso movement against dollar is the fact that it was could be the reason for lack of Mexico peso movement against dollar could be that peso was fixed against dollars and the Mexican government was intervening from time to time to maintain a certain value of peso against dollars. Is this correct? Right, students? This is making sense, right? So what happens when you fix your exchange rate against another currency? So the government uses foreign exchange reserves. What does the government do? So government uses foreign exchange reserves to make sure that your currency stays fixed against another currency, right? So let's look at what the marking scheme says. A number of reasons are acceptable. For example, intervention by the Mexican authorities in the foreign exchange market, or answers could be based upon the information provided in the extract. Small trade deficit that would be financed easily. For maximum marks, there could be some reference to the supply and demand for the Mexican currency, right? So you would say the market was fixed and the government was using foreign exchange reserves to maintain a certain value against dollars, right? So we do know that what happens with fixed exchange rate, either you revalue your exchange rate or you devalue your exchange rate. What is revaluation? Revaluation is that when it's going below a certain threshold, you sell foreign currency and you buy local currency. So that is known as revaluation. On the other hand, when you want to devalue your currency, what you do the opposite. You sell your local currency and against that local currency, you buy foreign currency. So that's devaluation. Correct? Is this correct? Right? So that's what you are supposed to write in this. Okay, next question, students. With the help of diagrams, explain how different, let me copy this first, right? So the next question here says, with the help of diagrams, explain how different economic experiences of Brazil and Mexico after 2011 mentioned in the text could explain the changes in currency values shown in figure 1, right? So after 2011, with the help of a demand and supply, with the help of a diagram, with the help of diagram, explain how different economic experience of Brazil and Mexico after 2011 mentioned in the text could explain the changes in currency value shown in figure 1. So let's see what the currency or what the case study has to say about this. So here's the graph. Here's the paragraph that we need to read. From 2011, it was Brazil's turn to struggle as China's demand for its raw material decreased. So what happened in 2011? The demand for Brazilian raw material, which China used to buy, is decreasing, right? It decreased, right? So what would happen to the demand for Brazilian currency? So if now a country's demand for its exports start decreasing, what would happen to its demand for currency? Would that increase? Would that decrease? Yeah, quickly. So students, what would you expect currency's demand to, what would you expect to happen to currency's demand if its exports are decreasing? Yeah. What do you think? Any idea, right? So obviously the demand would decrease, students. The demand would decrease. Why? Because when the foreign countries are now buying less from you, so they don't need to convert their currency into your currency. They don't need to convert their currency into your currency. And since they're not converting their currency into your currency, so the demand for your currency will not increase, right? Is this correct? Right? So the demand for Brazilian would decrease. And let's see if this is the same thing shown on the graph. So have a look at this. Where's 2011? So in 2011, it was somewhere over here. After 2011, if you see, there was a sharp decline. There was a sharp decline in Brazilian real against dollars, right? So exchange rate was depreciating. Why? Because the demand for Brazilian real was decreasing, and therefore Brazilian currency was depreciating, right? Okay, then what happened in 2013 alone? Brazil currency depreciated by more than 10%. In 2013, Brazilian currency depreciated by more than 2013. You can have a look at this. So there's a sharp decline, right? More than 10%. Yes or no? Is this correct? Right? The Brazilian government largely wasted the boom years, blah, 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 right? Now let's look at the question again. With the help of diagrams, explain how the different economic experiences of Brazil and Mexico after 2011 mentioned in the text would explain the changes in the currency value shown in figure 1. And what happened to Mexican currency, students? So after 2011, can you see there's a slight increase and then a decrease, right? So even for the Mexican peso, I mean, it was basically overall a decrease between 2011 and 2012. Yes or no, right? So let's see what it has to say about Mexico. Right? Meanwhile, the Mexican government used the past decade to significantly strengthen its economy, improving the education system and making its telecommunication, financial and energy sectors more efficient, right? Economists are now expected the country to grow more rapidly when Mexico's biggest trading partner, the USA, recovers economically. So when the US is recovering and US is Mexico's trading partner, when USA is recovering, which means the economy is recovering, so now they will buy more goods from Mexico. So what would you expect the currency, what changes in demand and supply of Mexican peso would you expect? If our trading partner is now recovering, and we would expect that now more trade will take place. So what would you expect to happen to the demand for that currency, right? Demand would increase, and overall the exchange rate would appreciate. And therefore, overall, the exchange rate would appreciate. Students, are you following me or not? So if you're still confused, let me show you the graphs, right? Okay, now we will draw two graphs, one for the Mexican peso and one for the Brazilian real, right? Now for the Mexican peso, students, let's look at the Mexican peso first, right? So what we would see is basically, right, that in 2011, it says that US started recovering, US economy started recovering, which means that now USA will import more from, right, peso, right? I don't know what the sign of the peso is. So I would simply write how many dollars can each unit of peso buy. So it would be simply dollar. It would be dollar slash peso, right? On the y-axis, and what you will have on the x-axis, so whichever of the two is the second currency over here on the y-axis, I've told you, right? That would be on the x-axis. So you will have quantity. You can write the full form, but I'm just writing Q. So quantity of peso is on the x-axis, and dollar, how many dollars would each peso buy? That's on the y-axis. Now what you will draw here is a downward sloping demand and an upward sloping supply of which currency? Peso. So upward sloping will be supply of pesos. Downward sloping would be, upward sloping will be your supply for pesos. Downward sloping will be your demand for pesos. Easy? You good on this? Okay. Now, wherever the two graphs were intersecting initially, right? So let's say, initially each peso used to buy $0.50, which is basically 50 cents, right? So initially, let's say each peso used to buy how many dollars? $0.50, right? Which is 50 cents, right? Now, after that, what happened? What's the case study saying? Case study saying that USA is recovering. So when USA is recovering, so USA perhaps would need more raw material, which it would import from Mexico, or there might be some other products that USA is importing from Mexico, which means that when they import products from Mexico, the demand for Mexican exports will increase. And when the demand for Mexican exports increase, what happens? What happens to the exchange rate? Students? When the demand for your exports increase, what happens to your currency demand? The demand for your currency also increases, right? Yes or no? So your new currency's demand curve would be higher. So it will move to D2. Now you can see for yourself that the new demand curve is intersecting with the supply curve at a higher point. And therefore now you can see for yourself that let's say each peso would now be buying how many dollars? Instead of half a dollar, which it was previously buying, let's say now it's buying $1. Each peso is worth $1. So which appreciated? Which currency appreciated? Peso appreciated and dollar depreciated. Easy. Any confusion, students? Any confusion? Anything that's not there? Now let's look at the Brazilian economy. Now for the Brazilian economy, right? Opposite happened. What happened? That the demand for Brazilian currency, real, right? That was declining. And why did it decline? It declined because now China was buying less. Now China was buying less raw material from Brazil, right? So dollar per real, how many dollars can each real buy, right? And which currency you will have on the x-axis, as I've told you previously, right? So the second currency on the y-axis would be the currency that you will have on the x-axis. So quantity of real would be on your y-axis, right? How many demand, how much is the demand and supply, right? So downward sloping would be your demand for real, upward sloping would be your supply for real, just like we showed for pesos in the previous graph, right? So you label it as S1 and D1. So let's say initially where the demand and supply were equal. So that was your, um, equilibrium in the market, right? So let's assume previously each real used to buy, right? You can assume any value, it doesn't make any difference, right? So let's say previously each real used to buy half a dollar. Previously, not half, I mean, let's change the value a little bit, right? So previously each real, let's say, used to buy 20 cents, right? Each real used to buy 20 cents or $0.2 as we say. Then what happened, since the demand for real, the Brazilian currency decreased because now China is demanding less from, is buying less raw material from Brazil, right? So the demand for your currency would decrease. And when the demand for your currency decreases, you can see that the demand curve will shift to the left. And now each real would buy less dollars, right? So what does it mean? It means that the real would depreciate against dollars, right? Now each real is buying only 10 cents. Each real is only buying 10 cents. Is this clear? Students, any confusion? So let's quickly go to the case marking scheme and let's see what it says, right? Okay. You will not only for this question, you not only make the diagrams, you will also explain in words that what was the reason why this happened. Correct? Okay. The changes in Brazilian values are a reflection of changes in the supply and demand for the Brazilian real and the Mexican peso. For an explanation of the reasons for the depreciation of Brazilian currency with due reference to the text, a number of approaches are acceptable. There was a decline in China's demand for Brazilian raw material, and as a result, decline in the demand for the real. There has been a rapid rise in the import of luxuries from the USA. Exactly, we forgot that, but we are good. We were just supposed to explain one reason from the US into Brazil, and therefore increasing the supply of real. A significant trade deficit in goods and services has developed. That means that the supply of real exceeded its demand, right? So if a country is importing more goods from another country, then that means that the supply increases. So you could look at from two sides, right? So one explanation for the Brazilian real depreciating could have been lower demand for its currency, which was because of China importing less raw material from Brazil. Or the second reason that was also mentioned in the case study was, more supply of real. And why would there be more supply of real? Because it clearly mentioned in the case study that Brazilians were importing more luxury items, right? Right? The Brazilian government, in addition, many households borrowed money to finance a consumer boom, including a rapid rise in the imports. So when you rise imports, right, when you increase your imports, then what happens, right? Is this correct? Right? So your currency supply would increase, and that also depreciates your exchange rate. Easy, we go on this. Okay. If reference is made to the waste of booms, the candidate need to go on to show that how this affects the value of the real through the impact upon the supply of the demand for the currency, right? For an explanation of Mexican currency is relatively more stable, or the one that explains the rise in the peso after 12 with due reference to the text, right? A relatively small trade deficit that could be easily financed, means that there's not a great excess supply or demand for the peso. If the reference made to the maximum government policy that has significantly strengthened the economy, the candidate needs to go on to show how this would prevent a large trade deficit from rising, right? Is this correct? But our explanation was also correct that, now when the US economy is recovering, there would be more demand for Mexican exports, and therefore the demand for Mexican currency would increase. Easy? Any confusion? Khizr, Sandhya, Zohan, we good on this? Right. Okay. Now let's move to the next question. Explain how the approach of the Mexican government. Right. So the next question here says, explain how the approach of the Mexican government during the past decade is more likely to generate an expansion of the economy than the approach of the Brazilian government during this period, right? So in the case study, it was referenced that Mexican economy took more effective steps to expand the economy, right? So the question is exactly asking you to comment on that. And what it's asking you to say is that explain the approach of the Mexican government during the past decade is more how the approach of the Mexican government during the past decade is more likely to generate an expansion of the economy than the approach of the Brazilian government, right? So what information we have in the passage? Let's first look at that, right? Meanwhile, the Mexican government used the past decade to significantly strengthen its economy, improving education system and making its telecommunication, financial, and energy sectors more efficient. So when that happens, students, what will that lead to, right? So when a country is investing in its, in its different sectors like telecommunication, finance, and energy, right? So that means that now these sectors are becoming more efficient. It might be more profitable for the foreign investors to invest in these sectors of your economy, which means more foreign direct investment, which means more employment opportunities and all that, right? Right. Economists now expect the country to grow more rapidly when Mexico's biggest trading partner, the USA, recovers, right? So USA is also recovering, which means that Mexico would have a chance to export more and all that, right? Also, Mexico is also exporting more manufactured goods to European market, right? Which means another export boom, and with more export boom, you get to make more. Aggregate demand is higher. When exports are higher, your aggregate demand is higher, and with that, what happens? Your GDP increases, right? The same aggregate demand, aggregate supply diagram. Yes or no? And Mexico, another good thing about Mexico was that it maintained a relatively small trade deficit. So its imports were not too much. The imports of Mexico were not that much. Yes or no? Is this correct? Right? And what did Brazil do wrong? So what did Brazil do wrong? So Brazil did not invest in infrastructure. This is where it says, right? So it did not invest in infrastructure, which means that it will not support the growth of the economy in the coming years, right? Moreover, Brazilian people were buying more of luxuries from the USA, which means a large trade deficit, which means more imports, less consumer, local demand for goods and services, which means lower GDP and all that, right? So this is what you were supposed to write in this. In Mexico, improving the education system and making the various sectors mentioned more efficient has improved the productivity of the factors of production and led to an expansion of the economy. In Brazil, the government wasted the boom years failing to invest in infrastructure. Candidates need to show understanding of the link between the actions of the two governments and the supply side of their economies. A further acceptable approach is to analyze the impact of the Mexican government's policy on aggregate demand in Mexico, as I told you, right? So when they're exporting more, there's more aggregate demand. When they're importing less, again, imports is not spending on local goods. So that would mean Less imports would mean more demand for local goods, and more demand for local goods mean more aggregate demand and more GDP, right? For an explanation of the ways in which the policy of the Mexican government would lead to an expansion of the Mexican economy through an improvement in the quality of Mexico's factors of production, or an explanation of the impact upon aggregate demand or of increased Mexican government spending, right? For a comparative statement referring to Brazilian government failure to invest in resources and fail to boost aggregate demand. Easy? You good on this? Okay, now the last question, students. Last question says, identify and evaluate the usefulness of any further information that might be useful in assessing the future prospects of the Brazilian and Mexican economies. Okay, so I would say that we are running a little short of time over here, students. So let's stop here for today. Tomorrow we'll continue from this question, right? Because I know that it's not enough time for us to do this question in detail, so let's not rush through it, right? But are there any questions from the previous, are there any questions from the other topic, like the other parts of the case study that we did? Any question of the case study apart from this last one that you did not understand, or you had problem understanding, right? If that is clear, so then we'll stop here for today, students, and then tomorrow we'll continue from here, right? Sounds good? Okay, so I'll see you tomorrow at the same time. Take care and have a good night. Allah Hafiz.